One of the most important principles in investing effectively, investing properly, growing your portfolio, protecting your portfolio is price momentum or price direction. It's not earnings, it's not price to earnings, it's not price to book, it's not fundamentals. It is which direction the stock or the bond or the currency or the commodity is moving, because that direction will stay in that direction until something stops it, which I believe is Newton's first law. So something in direction will stay. Now, right now, rates are going up, bonds are going down. And I want to talk about that because I placed a small bet last week that went against me about 3 or 4% on the interest rates. And I want to talk about why I did that and why I got out of it. And also why you want to get out of things that are moving against you or stay in things that are going with you. So my thought around this whole price momentum, price direction is super low rates are gone. Now what? The reason I want to talk to you about rates is because rates started moving up in a significant form really at the beginning of May, but they accelerated with Bernanke's comments on May 22nd. And then when he came out in his most recent Fed Open Market Committee communication, then rates continued going up. So the direction of rates bottomed a while ago, and they've been kind of bottoming, but now it looks like they've broken out. So the question is, what happens to bonds now, both bond prices and bond rates? What's going to happen to house prices? What's going to happen to stocks? What's going to happen to the US dollar or other currencies now that super low rates are gone? So let's go ahead and start answering some of those questions. On the screen here, you see the 10-year US Treasury yield. So over on the right, you see a small little black box that says 27.15 in it. You want to just move that decimal to the left one. So what that means is right now today, a 10-year Treasury in the US is yielding about 2.7%, which historically is really low. But as you can see, going back to July of 2013, looking on the screen here, I'll just put my cursor over by it right here, you can see that rates have basically gone from 1.4 up to 2.7. They've almost doubled to 2.8. Not quite yet, but they've almost doubled from a year ago, which is pretty amazing. And the May 22nd is this vertical line here. So the direction of bonds was going down since 1980. And I believe, and it looks like the bottom was put in a year ago when 10 years hit 1.4%. And here we are today, almost twice that rate, almost 2.8. We're at 2.7. So the direction, that momentum in bonds, which had been falling for 33 years, had been bottoming itself out over the last year and is now broken above this 2.4. And I said when bond yields broke above this 2.4% and stayed above it, that's going to be our indicator that super low bond rates are gone. Now I'm showing you the same price chart, but I'm just zooming out about 8 years. And this is still the 2.4% horizontal line that you saw on the previous screen. And you can see here this bottoming out period really happened in 2012 and 2013. And we broke above, and you can see a little bit that the price came back down here and then moved back up. So it appears, based on what is happening today, close of market for the first week of the second half of 2013, that super low rates are gone. And I think they're gone forever. And it looks like the new bottom will be about 2.4, or maybe there'll be a range between 2.5 and 3.5%. This horizontal line right here, that's actually 3.75%. So if you think of this one right here as 2.4, that's at 3.75. This move between these two horizontal lines, that could be the new range that bonds are going to start moving. So they'll still be low, but that super low rate is gone. Now, while this happened, stocks, this is May 22nd, and you can see they topped out. They literally peaked on May 22nd, or maybe the day before, which is pretty impressive that stocks themselves, and I'm not saying they've peaked and they're not going up, but they peaked that May 22nd day when Bernanke came out and said maybe we're going to start doing something in the future. Now they're only down 2%, so that's actually not that bad considering municipal bonds are down about 6%, TIPS are down, Treasury inflation protected bonds are down about 6%. So the fact that the overall stock market, the S&P 500, is only down about 2%, that's actually not that bad, and maybe it got above itself a little bit. And then this horizontal line that you see here, that's actually the market's old-time lifetime high, the 2007 and the 2000 lifetime high of the S&P. So it broke above it, sat back down on it, and is staying above it. So that is very bullish. Again, the momentum of stocks is up. Now the yield, interest yield, is also up. So this is really changing things. Now, the other thing I wanted to see is how this impacted the 30-year mortgage rate. And as you can see on the screen, it basically was bottoming between October of last year to the very end of April this year. So that's about 7 months of bottoming that took place. And then from there, that sub 3.5% rate for a 30-year fully amortized mortgage is now up about 4.5. And this price chart does not reflect the jump in rates today. So we have 30-year mortgage rates above about 4.5. Now look, to borrow money for 30 years as an individual and only pay 4.5%, that is ridiculously low. And I know here in Silicon Valley, inflation's running probably about 5%. So if you borrowed money at 4.5%, and depending on the tax bracket you're in, you're able to write off a third of those interest payments, then that 4.5% is really like 3%. So rates are still low, historically speaking, but the super low rates are gone. Now, how does that impact housing? The price chart I want to show you is the exchange traded fund ITB, which is all the residential housing stocks, and it's down 15% from May 22nd. So the overall market is down 2%, and housing stocks are down 15%. So we can probably say that higher interest rates are going to put a lot of downward pressure on housing stocks for sure. I mean, that's not a guess, that's not an opinion, that's actually happening. And it's going to slow the increase of house prices. The reason I don't think it's going to collapse the price of housing is because I think a higher, more stable 30-year fixed rate at 4%, maybe 4.5, is probably better for the housing market long term. It will slow the appreciation, and obviously it's upsetting for people who did not get in at that 3.5, but it is a healthier market that can have a more stable mortgage rate connected with it. So overall, it's going to help the stability of it and give it more health long term, even though it will slow down the upward price of housing. But housing stocks clearly down 15%, 7 times worse than the stock market during the same time period, is telling you that residential housing stocks will avoid them right now, and they may have seen maybe their best, most recent runs. Then I wanted to look at two currencies. I wanted to look at the US dollar, and then I wanted to look at the Australian dollar. And the reason I wanted to look at the US dollar is because still today, when people get scared or people get concerned, whether they live in China, Australia, Wales, the UK, Canada, Chicago, people still move to the US dollar. And what was interesting to me when Bernanke's statement came out on May 22nd, which is the vertical line over on the right of the screen, the dollar fell. In fact, it immediately fell. But then when he came out with his FOMC meeting saying, we think if things stay good, we're going to start taking our foot off the gas pedal and buying less or printing less. Not turning the printing press off, just printing less. And since that statement happened, the dollar has gone back up, meaning people still like the dollar when they get concerned. And the dollar is holding up really well. Now, this last image I want to show you is the Australian dollar, which fell from 105 down to about 90 today. That is pretty significant. That's about a 14% drop. The reason I had the Aussie dollar on here, kind of opposing the US dollar, is a lot of people consider that when people do the risk on, when people say, hey, let's go in and let's make a lot of money, and there's been this phrase risk on, risk off. I've called it polarity investing. People move into the Australian dollar. And with the Australian dollar down about 14%, which is a significant move over that short time period, you can see that it broke its old support at about 94. And its next major support is down about 82. So if this price momentum continues, meaning rates continue to go up, we could see the Australian dollar go down to about 82. Now, what do you do with your portfolio? How does it impact your portfolio? How does it impact your investments? I'm going to talk about that on Tuesday, about what sectors, what investments have done well, are doing well. And I talked about it before in, I believe, last week's market situation report that certain areas of the financial sector are doing well, but there's a couple other sectors too I want to show you that are doing well. And in fact, not only are they doing well, not only have they held up, but they're actually going up in the face of interest rates also going up. And so I want to let you know what those are, and I'll be talking about those this Tuesday, July 9th, with our July monthly strategy gathering. So there you are, guys. I guess you can call it the 4th of July weekend still. At least it feels like that in the States. I hope you all have a safe weekend, and I will be speaking with you guys on Tuesday. You take care, and I'll speak to you then.